Now we want to look at financial conditions for the consumer, for businesses, what is happening and and what does it mean going forward as if we think about the ease of getting loans and money into the hands of people that may need it. And here you can look at financial conditions clearly at the lowest, at least going back to 1990. And the question is going to be, can they get access to the capital? What does that mean? And as you see this ease, what does it mean on the back end? Are we going to see inflation? Are we going to see, bad debt expense going up because the money is just being pushed out? This is going to be something to watch as we look at the financial conditions in terms of getting, free money into the market, which is why when we look at the break-even inflation rate, you can see we're starting to, we've been grinding higher and now we're pushing that 2%. Because there's, again, that rising fear of where is inflation? It's starting to creep up. We're seeing it in prices. Now that we have crude prices going above 50, that's going to push prices up even more. If we think about diesel, because when we talk about in the last segment, the issues with bottlenecks, this is happening with diesel prices at 280. What does that look like with diesel prices at 380, at 480? And again, this is why when we start to see those pressures going up, that's when you start to see the ratcheting of inflation and what is that rate going to look like as we have new means of just where the pressure is going to come out. And then when we look at, credit caution, a survey of 86 banks by the Fed asking participating lenders for the reason they didn't improve Main Street loan applications. Firm and poor condition pre-virus. I think that is the biggest one where, borrow ineligible, terms unattractive. Again, those two things pre-virus. And that's why when we talk about the issues in 2019, why we started to get concerned about the market in 2019, this is, again, there were issues already in the market. And COVID just ended up being that jet fuel on a forest fire. And the pressure continues to mount. And that's why when we look at, where this is, because key terms unattractive to bank, again, rates, planned use of Main Street loan not sound, firm too severely affected by virus. Those are things that have to be considered when we think about how quickly will we get money into people's hands? What will it be used for? What will the investment be? And will it generate jobs? Because right now, again, even though we're seeing Fed buy stuff to give banks dollars, we're not seeing that turnaround because the terms still aren't eligible, are still unattractive for what the bank is looking for, what a hurdle rate may be. And again, this is putting pressure on how do you get the money into those hands given the different loan applications that have been rejected. Now, obviously, there's not as many as there were previously. We had a significant tightening in loan requirements. That has started to back off. So this should start to get a little bit better. But again, you're getting an idea of what is the underlying problem, which is why firm and poor condition pre-virus is, I think, a big one as we look to additional bankruptcies in 2021. Because if you were struggling pre-virus, now you have the virus, you can't get a loan. I mean, again, this is why we're continuing to see bankruptcies. This is why we're seeing less workers because they're trying to do everything they can to stay alive. But with that being said, just issue SPACs. And here you are, this is going back to 2009, and you can see the growth from 19 to 20 in total money raised by SPACs at $82.11 billion. This speaks for itself. I mean, if you want to give money to a SPAC, okay. But again, this is just something to watch as we go into the new year, which is why when we talk about interest expense. So when we look at, as we talked earlier, and the reason why I come back to this is because there is an issue with how much the government's going to be able to buy and stimulate, because we're already seeing a significant outlay because they're borrowing more than ever. And now this goes to 2019. So this means that this doesn't even capture the stimulus we've seen in 2020. So when we factor in where we were coming into this year, where interest expense was going up as a percent of gross GDP. So, as GDP, but again, as GDP falls, this number gets worse. And if GDP rises, but it's on the back of government spending, well, then you're still going to get an increase. And again, like even though we're cutting interest rates, we're seeing rates at historic lows, our interest expense is still going up. And it's because GDP sucks, yes, but it's also because we're borrowing so much, there's more interest to pay off. This is why, again, looking at what it is, what will this do to the ability for the government to pay off its debts, and what does that mean for the consumer? What does that mean for the citizen as we continue to struggle to see how do we get to the other side? What stimulus is needed? And then how do we pay this off? Are we going to have austerity? Are we going to maybe see some growth in or a new industry develop that will bring new GDP life as we saw in the 90s? Like these are things that we have to consider to see how do we adjust this, because as you look from 1945, the end of the war, which we saw interest expense come up, it took almost 20 years to pay off a lot of this debt and to have the interest expense come down. And now, you saw it ratchet way back up as obviously GDP became a problem and you had inflation. But again, these are things that we have to consider because this obviously interest rates were very high. But even though interest rates were high, savings rates were high. So you may have gotten a mortgage for 21%, but your money market account was paying you 17%. And again, incentivizing savings, not to say that we should be at 21%. Don't get me wrong. I'm not saying that. But if your mortgage or something is 6%, 7%, then the bank will be willing to lend to you and your money market account will be at 3%, 4%. So what are you actually paying? And this is, again, incentivized savings, incentivized, taking care of yourself, being responsible with your money versus the adage of just buy anything you want. And if it goes wrong, they'll just bail you out. Again, that moral hazard that we've been seeing. But how are people adjusting? And I think this is a big thing in terms of, migration. This is coming from U-Haul, which is, did their 2020 migration. The top 15, Tennessee, Texas, Florida, Ohio, Arizona, Colorado. Again, away from, going urban to suburban. And at the same time, who doesn't have income tax? Like how much of this are people that can move, trying to move to avoid taxes? Because then where are you moving from? California, Illinois, New Jersey, Massachusetts, Maryland, Oregon, Louisiana, Connecticut, New York. I think it's quite clear what some of the driving forces are in terms of standard of living, cost to be there in terms of taxes. But again, standard of living, taxes are the key components. And if you see cities getting ripped apart, you start to get concerned about your safety. Plus, what are your job prospects? And if you're maintaining your job, can you do it from Tennessee? Because, okay, I can do my job instead of being in California, I can go to Tennessee, and instead of my, $100 providing me $70 of utilization in California, $100 provides me $125 of utilization with the same salary. Tennessee, 10 out of 10, plus there's no income tax. So I should say state income tax, obviously. So these are things we have to consider when we're looking at how is the migration and what is this going to do to, again, the urban to suburban driving. Will we see more or less driving miles? These are things that we have to look at on the long-term impacts as we consider people who want to work from home more. But again, coming back to personal savings, personal savings as a percent of disposable income, spike and fade. And this is why, and we have other charts showing why. You had a 12% increase. So you had the increase and then it failed. Again, this is coming in 2013, 2014, 2012 to 2013. And we had something similar. Now, can the $2,000 check help slow this? Can the $900 check slow this? Yes. But again, it's just going to slow what is inevitably going to happen because the people who are getting the money are already living paycheck to paycheck, and this is going to go into savings and immediately leave. So again, it's a shot in the arm, but it's not enough to get us to the other side, because when we look at this, from the perspective of entering 2021 with initial jobless claims as of late December at 787,000, still above prior peak of 695,000 in early 1980s. Continuing claims, which is in the chart, is at 5.2 million, a bit below the prior peak of 6.6 million in 2009. How are we going to give these people money when the employment is the biggest problem? Because yes, we came off hard off the top, but as we talked about bankruptcies, as we've talked about hours worked, that is going to become a much bigger issue as we look to get into a normal system, which when we look at just what are the benefits overall. So total, this is regular, federal, pandemic, 19.6 million people are receiving some form of unemployment benefits. This is an overarching problem into how are we going to adjust? How are we going to give people money? And that's why going from California to Tennessee makes a lot of sense. New York to Tennessee, that's going to make sense because, again, cost of living, I can have my money go further. And again, what is that going to do to everything else? When we start to look at how people are going to work, how often would you like to work from home? 27.3% said they would like to work from home 5 days a week, 4 days a week, 7.3, 3 days a week, 2 days a week. Again, this is why we continue to highlight there will be a blended schedule on the other side of COVID. It will be something that, 5 days a week, I think will be hard. And I don't know if corporations will go for it. And I've shown data on how they won't. But 2 to 3 days on a blended schedule is very doable. And it's something that the companies, as well as people, have been willing to accept and willing to test out. And again, that is going to limit the amount of let's just be fair, the amount of gasoline consumed, because people driving to work, there will be less, and this is, if you think about where are most miles consumed, it's in the Midwest, it's in the South, it's in the, West Coast. And if I can work from home, I'm not going to be driving all that much. Well, again, like you'll still go to the store, but when we look at people going from urban to suburban, they're still going to use what has become native to them and what has become, essentially within their workflow, which is Amazon Prime, Uber Dash. Those things aren't going away. They're just going to be consumed differently, and it's going to change the spending patterns of those in the suburban areas. It'll make FedEx, UPS, USPS more efficient because that route is being driven every single day. The amount of packages on that truck will change, but that gentleman or woman, that driver in general, or that truck is moving that same route regardless of if you buy something. So again, it's just going to increase, the effectiveness, the efficiencies, and it's going to limit the amount of actual gasoline consumed, especially as we start to see this take hold. So then when we look at, okay, well, why are people so confident about the market when you have insiders who are selling? And again, as we continue to see November, December, as the market screamed to all-time new highs, you have people, insiders, that are selling their stock, not buying their stock. And it's just something to consider, because when you think about, okay, people are going to get cash, they're working from home more so they can do things outside of working components, and they've been trading more. But yet they're buying things using leverage while everybody internally is selling. So, well, how active have people gotten? Well, here's your day trading moves. Here's your trading strategy, your option strategy, your swing trading. We are at all-time highs as of, obviously this is June 19th, coming down, and now you're giving people $2,000, and I can assure you some of that will come back in here. And if you look at July 31st of 2009, you can see where we peaked and where we are currently. Obviously, 2018, day trading, everything was very frothy. Things were going up. People felt good. This is a whole new level of frothy, and it's just going to be a matter of how quickly does this adjust, or does it adjust, or is this going to be, are people so addicted to it now, they're going to continue? Because let's be fair, there's been limited pain. If you bought every single dip since March, you crushed it. So when do these individuals who are in trading strategies, who are in, feel pain and feel, because obviously this is a marathon, not a sprint. I've been wrong. Luckily I've been right more than I've been wrong, but this is the market. I mean, if you're right 70% of the time, that's a home run. And so again, we haven't had any pain. And how are these individuals going to manage their risk? Because again, you're not managing money, you're managing risk. And how do they adjust to, a drawdown, or what does that look like especially when you're trading on margin? So then when we look at change in spending, again, people are buying less. So this also gives them more money to play with, because people are doing less with that money. You're spending, and again, this is as of the December 2nd, home, groceries, restaurants, apparel, department stores, everything is change in spending. It was going down. And again, we saw the spike. Obviously, we saw this huge spike as people prepared for lockdowns, COVID. People got money to spend. But again, travel and transportation, that's why we always joke. Yes, there's deflation if I eat airline tickets and concert tickets and drink oil, but I don't, because let's look at where spending is, where prices are going up. And that top piece, even though all of these are going down, nobody's buying it. So even though prices have fallen, nobody's purchasing it. So nobody's realizing this deflation, but they're experiencing the inflation as they don't have jobs, as they don't have falling wages, maybe earning 70% of original due to furloughed or due to blended schedules. Again, these are things that are a problem as we head into the new year. Average debt added over the holidays increased just because people were using more money to buy stuff to try to keep Christmas fun, as I think every mother and father tried to do for their children. But again, this is going to limit, because when you give someone $2,000, did they borrow against that? Because they're like, look, I know I'm going to get at least $900 from the government. So if I get another, $1,100, I'll just pay it off. So I'm going to borrow against it. And then when we look at how consumers funded their holiday spending, obviously credit cards, personal loans, store cards, those are things that can get paid off as the money comes in and the checks are delivered from the government. But when we look at, margin debt and how people are consuming, margin debt versus the S&P 500, we are at peak levels that we saw in 2007, the levels that we saw in 99, prior to the tech bubble, prior to the financial crisis. Now, everybody is leveraging up. Again, how will these individuals manage their drawdowns, because they don't have the capital? But let's look at this now. Okay, yes, people got money. People got $1,200. But let's look at the first income quartile, which again is at the lowest level. So first quartile earned between $12,000 and $30,000 in labor income. So they took the money and immediately went into savings. Then they proceeded to pull it out of savings at a very rapid rate. Same with second income quartile. So, and then as you get to the fourth, these are people that are getting less of that money. So there's less of a bump, but again, they can pay their bills without pulling from savings. So you gave them some additional money and they're going to leave it in the bank. The first, second income quartile, yes, savings popped, and people want to point to, well, look at the built up consumer demand. They are experiencing higher prices for everything they purchase on a daily basis, and they may not have a job. They may be earning less than usual because they can't get childcare. They were sick. Their employer cut their hours. That's going to pull more out of savings faster, even though they had the biggest percentage increase. They're having the biggest percentage drawdown. So again, you have to look at both sides of it, especially when we look at income growth dwarfed by rising costs. Wages since 2000 are up 10%. I would argue lower, but let's use this. Okay, so they're up 10%. Your housing cost is up 32%. Your healthcare cost is up 55%. Your education cost is up 57%. Your childcare cost is up 37%, up again because of COVID. Healthcare, again, it comes down to weightings. My healthcare costs more than my mortgage. When I strip out escrow and taxes and whatnot. So when I pay principal and interest for my mortgage, My healthcare is $500 more. That is not a sustainable thing for many people. And again, when we think about how is inflation weighted, how are people calculating inflation, that is a bigger problem when we look at healthcare costs, because that is just the premium I pay. That isn't deductibles. That isn't co-pays. That is just the monthly number to just have insurance for the family. Once you factor that in, it's even higher. Again, these are problems that are going to persist and are going to impact the way people spend. Now, average daily visits to websites. So again, people, well, this is the trading. You're seeing people trade more, but okay, so they're trading more, but what are they doing with the money? Because there are people that have that additional, that third and fourth quartile, have the ability to have Robinhood, TD Ameritrade perhaps. So let's look at income. So wages fell 43 billion. Unemployment insurance added 500 billion. Stimulus checks 276 billion. Income, in terms of what it is, 29 billion. All other income, 265 billion. Total disposable personal income, 1 trillion. Not evenly dispersed. Some things have gotten lost, as we've been showing with first quartile, second quartile, but there is a lot of money sloshing around. Where did it go? Who's using it? And that's why when we see the bottlenecks, the increase in prices, this continues to be a bigger problem as we're seeing inflation going up in terms of prices. And spending decreased. So durable goods went up, non-durable goods went up. But again, services, interest payments, these are things that have gone down. So total household outlays are down 535 billion. Nobody's buying airline tickets, or fewer people buying airline tickets, concert tickets, sporting event tickets. They're buying stuff, for the family, but that stuff is starting to cost more because bottlenecks, price increases. Again, so these are the issues. As wages fall, as wages come under pressure, people have less money to spend because of it. And this is why savings are there. There's a huge spike in savings. It came away quickly, and $900 to $2,000 is not going to change that for the future. It'll be a shot in the arm. The question is, does that get us to the other side? And just given how I'm viewing Q1, Q2 of 2021, my answer is no. And then when we look at, just in terms of where things are sitting, now we have to look at Europe, and then we go to Europe, then Asia. Are we the only ones? And the short answer is no, but it's different for everyone. And it's important to appreciate how different, because this is going to drive imports, exports, FX, which is going to have implications for our market and other markets in terms of how do we access capital and where is some of these dollars flowing.